Nikkei 225 is balancing on a razor's edge at 69,737, one dangerous step from 70,000. Overbought stochastics, a weak ADX, and ISM Services hours away. This is a textbook trap. Nikkei 225 is hanging at 69,737, barely breathing beneath the 70,000 wall. Every headline says strong buy, every timeframe screams bullish, but there is a trap being set that will wreck the herd, and I need you to see it before the ISM Services number drops. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. That's not a forecast, that's a plan with exact entry, stop, and target. And if you miss the 70,000 trap, you miss the biggest liquidity event of the week, session bias. We are in a technical uptrend on every single time frame, monthly, weekly, daily, 4-hour, 1 hour, all screaming strong buy. But my veteran instinct is flashing red. The daily stochastic is pinned at 95.5. Williams %R is minus 4.7. Those are extreme overbought levels I only respect when they appear right at a massive psychological barrier. The ADX is stuck at 17, a pathetic number that tells you this trend has zero conviction. So I am labeling this zone a trap, not a breakout playground. The one line that separates the melt-up from the freefall is 70,000. Write this number down. If we get an hourly close above 70,100, the trapdoor opens upward and we could chase 70,800 fast. But if price rejects here and closes a 4-hour candle below 69,900, the stop hunt begins instantly, and the liquidation could shred 500 points in a single session. The herd is massively long off the weak yen narrative. That positioning is the gasoline. A single US data spark and we have a fire. Pull up your daily chart. Price is sitting right on the 70,000 pivot, the exact number that's been both ceiling and floor for weeks. The daily candle right now is a tiny doji with a long upper shadow, a classic exhaustion print. The moving averages tell the longer story. The 20-day moving average is at 69,362, sloping up and acting as the critical support floor. Below that, the 50-day is at 66,423, and the 200-day is way down at 57,539. That vast gap is why any real correction can run far and fast. The 20-day MA is the anchor. Lose that, and the trend structure breaks. Now drop to the 4-hour chart. Here's where the hidden signal lives. Price carved a rising wedge pattern, and the MACD histogram is printing lower highs while price grinds sideways. That's a hidden bearish divergence, momentum bleeding out while price refuses to break higher. Most traders will look at the strong buy label and click long. They'll ignore the oscillator exhaustion because the trend is too strong. That's exactly the mistake that gets you run over at a liquidity event. The 4-hour MA20 has flattened near 69,700, acting as a magnet, but volume is thin. The trap is being built above 70,100, where stops from late shorts and breakout chases are piling up. Smart money will likely run those stops before deciding direction. Scale down to the 60-minute chart. Price is hugging the MA20 at 69,700, but the last 6 candles are small-botted, indecision. The hourly RSI sits at 54, neutral, giving no edge. But the stochastic on this lower time frame hasn't reset yet, still elevated. Here's what most traders miss. In a low ADX environment, every strong buy signal at resistance is a fading opportunity, not a breakout entry. The exact numbers you need on your screen right now. Support 1 is 69,903, support 2 69,824, support 3 69,725. That's right where we are trading now. Resistance 1 is 70,081, resistance 2 70,180, resistance 3 70,259. The pivot is 70,000. Memorize these. I'll reference them for every trade. Cross-asset linkage is the secret edge today. The Nikkei is a pure yen proxy. US dollar to Japanese yen is wobbling near 152, with the intervention ghost looming. A hot ISM Services print will spike US yields, widen the rate differential, and crush the yen. That is rocket fuel for Nikkei. But a weak ISM collapses yields, sends US dollar to Japanese yen tumbling, and unwinds the carry trade viciously. That unwind is what could trigger the free fall. So the Nikkei trap is not just a technical setup, it's a macro binary event wrapped in technical exhaustion. The last 24 hours gave us a shaky US jobs report and flat Japan stocks closing slightly higher, but the real story is the ISM Services number in a few hours. The market is eyeing it like a hawk. A print above 52 would scream that the US service sector is still hot, keeping the Fed hawkish, driving the dollar and yields higher, yen weaker, and that could be the spark that finally punches Nikkei through 70,000 with a melt-up to 71,000 in days. Conversely, a print below 51.5 would be a recession whisper, yields crash, yen strengthens violently, and the carry trade that lifted Nikkei to these highs suddenly unwinds. The institutional ETF flows into Japan equities have been positive, but the positioning is crowded. Smart money will fade euphoria at the number.my 1 to 2 week directional lean is cautiously bullish only while we stay above the daily MA20 at 69,362. The exact invalidation, a daily close below that level flips my short-term bias. Bearish and targets the 68,000 demand zone. The event that invalidates the bullish thesis isn't a level, it's a weak ISM. So the tactical plan must handle both outcomes. Second interaction trigger. Do you think the Nikkei breaks 70,000 this week? Comment breakout or rejection right now. I'm tracking consensus in real time. It will tell me how crowded one side is, and I'll share that tomorrow. Most people skip this section. That's exactly where the money is made. Keep watching, because I'm about to hand you 2 scalp entries and 1 swing trade that can profit whether we melt up or trap. Strategy 1. The opening scalp, pivot bounce. This is a high probability long scalp right off the 70,000 pivot, designed for the immediate aftermath of the ISM print, assuming the number isn't a disaster. Wait for the first 5-minute candle after ISM to print. If price taps the 70,000 support and then forms a bullish engulfing candle on the 5-minute chart, meaning it closes above the open of the prior candle and the body engulfs it, you enter long at 70,020. That's 2 ticks above the pivot. Your stop loss goes at 69,970, just below the session low and below S3. That's 50 points of risk. Take profit 1 is at 70,180, resistance 2. That's 160 points of reward, a solid 1 to 3 risk-reward scalp. If momentum explodes, you can trail a runner to 70,259. This scalp is instantly voided if the 5-minute candle closes back below the 70,000 pivot before triggering, or if the spread widens violently without the engulfing pattern. Strategy 1. The opening SCALP entry, 70,020, 5M bullish engulfing after pivot tap, stop loss, 69,970 take profit 1, 70,180 take profit 2, optional 70,259 risk, reward, 1:3.0 R invalidation. Void if 5M candle closes below 70,000 before entry. Strategy 2, the liquidity grab, fake out reversal. This is the trap trade. After a hot ISM print, smart money will likely engineer a stop run above the recent highs. Watch the zone between 70,100 and 70,150. If price spikes above 70,100, triggers a flurry of breakout entries, and then within the next 10 minutes reverses and prints a 5-minute close back below 70,050, you have your short signal. Enter short at 70,030 with conviction. Place your stop at 70,170, just above the high of the wick. That's 140 points of risk. Your first target is the nearest liquidity pool at 69,900, the S1 support, a fast 130-point snipe. If the trap unfolds aggressively, you can aim for 69,800, S2. This scalp requires fast execution and absolute discipline on the stop. If the breakout holds and we get consecutive 5-minute closes above 70,100, the setup is invalid and you stand aside. The beauty of this trade is it capitalizes on the overbought exhaustion and the fake-out that retail chases. Strategy 2. The liquidity grab entry, 70,030, 5M close below 70,050 after spike above 70,100, stop loss, 70-170 take profit 1, 69-900 take profit 2, optional 69-800 risk, reward, 1:0.9R to TP1, 1:1.6R to TP2, quick scalp, invalidation, void if 25M closes above 70-100. Here's the interaction cliff. Are you scalping or swinging this week? Comment scalp or swing right now. I want to see where this community sits, because the crowd style tells me where the liquidity pockets are. Strategy 3, the session swing, trend pullback. This is the trade that aligns with the multi-timeframe strong buy, but it won't trigger unless we get a clean pullback. The daily MA20 at 69,362 is the magnet. I want to buy a dip into that level, not chase the breakout. Set a limit order to go long at 69,400, a level that has acted as intraday support and sits just above the MA20. Your stop loss goes at 69,200, below the 20-day MA and below S2, giving structural room. That's a 200-point stop. Take profit 1 is the psychological 70,500, a clean swing target that yields 1,100 points. Take profit 2 stretches to 71,000, a level that aligns with the weekly breakout projection. That gives you a risk reward of over 1 to 5. The trade is valid only if the daily close stays above the MA20. A daily close below 69,362 invalidates the swing and would shift my medium-term outlook bearish. Once price clears 70,000, you move the stop to break even, then trail it under each subsequent daily low. This is the trade that rides the underlying macro trend if ISM doesn't wreck it. Strategy 3, the session SNG entry, 69,400 limit, dip to daily MA20 support, stop loss, 69,200 take profit 1, 70,500 take profit 2, 71,000 risk, reward, 1:5.5R to TP1, 1:8R to TP2 invalidation. Daily close below 69,362 voids the swing bias. Never risk more than 1 to 2% per trade, and on these scalps, risk even less, 0.5% max, because the volatility on the ISM print can gap beyond stops. No positions through the actual ISM release. Wait for the 5-minute candle to close, confirm the pattern, then act. Stops are non-negotiable. This is how you survive to trade the next big move. Respect the trap, but don't fear it, plan for it. Everything you need for the next 24 hours comes down to one level, 70,000. If we close above 70,100, the monthly trend confirms a new leg higher, and the swing trade is live. If we break below 69,362, the trap snaps, and I'm targeting 68,000. I will have the updated blueprint exactly 24 hours from now, after the ISM dust settles and the real positioning emerges. If you want the full breakdown on the Aussie dollar, Japanese yen, and how it's driving this risk proxy melt-up, that video is live right now. Tap the end screen and watch it next. Then hit the bell because tomorrow's Nikkei alert lands before the Tokyo Open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter before the move happens. The trap is set. Now you have the map.